Talk to me about what you see in the short term.
I thought Mike set up the issues really well in terms of what I'm talking to investors about. How much, everyone knows earnings are too high. How much are they going to come down? What's in the price? I do think that positioning is such that people think it can still go higher in the short term, but it's a little bit of a game of chicken, right? Because I think people know what's coming is still going to be a generally hawkish Fed, and that probably isn't great for the price-to-earnings ratio people pay for the earnings. And the question is, as the earnings are coming down, will you think they're going lower than they actually would? Do people get bearish at the bottom? Yes. So we'll see through October earnings season, conferences you mentioned this week, Carl. There's some data points coming where for people to get a feel for how much earnings are going to come down.
Yeah. Have you been impressed that it hasn't really hit yet?
Two things there. Look, we all knew what was Fed Fund futures started going up in November of last year, but they didn't act till March. So the idea that we saw Q2 earnings, which are April 1st to June 30th for most companies, and the full impact of the liftoff in March was in the numbers is kind of silly, right? It's probably lagged by somewhere between 1 and 4 quarters. So I think you'll start seeing the slowdown in the earnings estimates. One chart we made that really I can't stop thinking about, public companies that do consumer, basically 20, 30-year revenue growth, 6 to 8% per year, trailing 12 months between 20 and 30%. So obviously we pulled forward some revenue from 23 and 24 into the last year. And so the question will be, how much does that come down? I think there's a narrative now, consumers going to hold up okay. Mike's point, maybe there's a higher probability of soft landing. That fuels the positive narrative. But the reality is the numbers are going to come way lower for the consumer. We know that, and so the question is, how much of that is in the price? I don't think it is. So we're playing chicken. A little near-term rally, but we know we're going to get something bad later in the year.
So you don't think it's in the price?
I really don't in terms of the medium-term outlook, because how can businesses that grow 6 to 8 for 20, 30 years grow 20 to 30 sustainably? They can't. These companies either slow down on pricing power, the economy slows, et cetera. Wages probably don't inflate at the same rate they were. Certainly they won't on Wall Street when we get bonuses in January and February of next year, with no M&A and the like. So I think you'll see a slowdown in the consumer probably from Q4 this year through Q1, Q2 next year, and it's just a little early to see the impact, when you only lift it off in March.
I do wonder about where the pain is going to be applied and where you're going to see more resilience, because consumer cyclical stuff, housing related, those stocks have definitely worn the risk at this point. But industrial's holding up okay. You still have the mega monster cap top 5 names where it's just trimming of earnings estimates,
right,
which is a huge chunk of the index profits.
I think you make a good point, right, which is nominal versus real GDP. I think about that all the time. None of us in our lifetime have seen 8% nominal GDP, 9% CPI, 8 minus 9 is -1. Right. We've seen a lot of 2% nominal, 3%, and that's the same -1. So I think the unit sales have still been pretty good. The bigger companies can protect their margins a little bit better than the smaller ones. So Mike's point's spot on. Small cap companies have actually seen meaningful downward revisions in the last 6 months. The big ones haven't. And so I think what's a natural thing is at some point the big ones run out of the ability to keep protecting their margins. You mentioned some of the trends. So I agree with that, and I think that's what's coming over the next 6-9 months. It's not an apocalyptic view. It's just, it's natural. You have a lagged effect, and the numbers come down.
All right, so what does that mean in terms of what you want to be long and or what you don't want to actually own in this period?
Yeah, I really like healthcare. We did some work that shows it's really never been one of the top 2 performing sectors in an upcycle in the last really 30 years. And when I look and compare, portfolio strategy, healthcare services to consumer services, I believe their numbers are more achievable. I think people will need it. It's GDP plus. They have pricing power. So I like that. If I compare, say, pharma to staples. Staples are an area where they're very expensive, should have some input cost problems, have some currency problems, probably slow as the consumer goes down to private label and other stuff, and I can buy pharma at the same dividend yield. So I'm trying to find portfolio strategy where the estimates look more achievable, and the worst case scenario obviously is you're long something where the estimates are too high and it trades at a high multiple.
As we're talking, MasterCard with their spending pulse looking at holiday, they're looking for 7.1 in nominal terms. Last year was 8.5. Do you envision a future where delinquencies are the story, or is it not? Is it just?
Sure. It's probably 6-9 months early for that. 90-day credit card delinquencies are hovering at all-time lows, so you're not seeing the pressure yet in the consumer. But I don't know about you guys, but every time I watch a sporting event, there's some sort of buy now, pay later advertisement on the mound or in the end zone or something. So we know what happens after that 6-9 months later is they don't pay later. We've seen that every time.
No,
so,
AI is going to fix it. AI is going to fix the whole thing.
I don't think so, right? So I think that there's a lag. Yeah.
Can semis be viewed as idiosyncratic here? Oh, there's all this policy stuff, and then there's this sort of like indigestion the cycle, or is there something there?
So we have a quantitative metric called company-specific risk. It's how much of macro explains this returns, and what's left over we call company-specific. Of the 24 industries in the market, semis is the most macro. So, actually, strictly speaking, macro variables explain the returns more than anything else. Now, you have some news today. Maybe it's bad for NVIDIA. Maybe it's bad for the equipment. What did you say? Equipment? What did you say? But, K-Lag, Lam.
It's a subsector.
It's a subsector. I can say that. Nobody else is allowed to say equipment.
I liked it. But, so I think, people are trying to figure out, is that bad for K-Lag or Lam or whatever? But I think when you look out medium to long term, those businesses have tremendous pricing power. The world can't function without them. They grow above GDP. So you're in this weird pocket of maybe it's bad for the China consumption in the near to medium term, but probably they're good businesses in the long term.
Yeah. That was good. It's nice to have you in the morning.
Always good to see you guys. Yeah. Have a good day.
You too.
Adam Parker. As we go to break, take a look at the roadmap for the rest of the hour. Chip names, as we said, under some pressure as the White House looks to widen some of the curbs on the industry.
Plus, if you think New York private schools are hard to get into, that's New York City, well, try Florida. We're going to speak with the head of the Benjamin School. It's a top private school in Palm Beach about a growing wait list and backlog.
And finally, the latest on Twitter as shareholders get set to vote on a Musk merger. And a whistleblower heads to the Hill. A big show ahead. Don't go away.
The White House reportedly planning to broaden curbs on U.S. shipments of semiconductors that are used for AI and chip-making tools. Our Kayla Tausche has the latest for us. Kayla.
David, the Commerce Department has already begun limiting the export of certain chips to China and, by extension, Russia that could be used militarily, and now could expand those curbs to include technologies seen as more